Okay, so you've sent me a ton of stuff on business finance, and it's fascinating. We've got articles, case studies, like the whole shebang. And what we're going to do is take a deep dive into how businesses get the money they need, to run things and to grow.
Yeah, exactly. You give me a really broad view here. It's everything from how a startup gets that very first bit of cash, all the way to how big companies think about, well, serious long-term financial strategy. Our goal is to really give you a solid understanding of these different paths to funding a business, but without getting bogged down with, the super technical jargon.
Yeah, for sure. No one wants to get lost in the weeds. So, one of the first things that jumped out from the material was this distinction between where that money comes from. It's either from inside the business or from external sources, right?
Right, yeah.
So, maybe we can start by looking at those internal options, like how a business can basically use its own resources to fund itself.
Sounds good. Let's start there. So, with those internal sources, we're talking about money that comes from within the company itself. They don't have to go out and find investors or get loans. And the first one, the one that's often, well, the most vital, especially when you're starting out, is personal savings. That's also called the owner's capital.
Yeah, and that one seems pretty straightforward, right? It's the person running the business, the entrepreneur, putting their own money in. And it's interesting, the stuff you sent over really highlighted how common this is, especially for those brand new businesses. It's often the most frequent way they get those first funds.
Oh, absolutely. I mean, imagine someone's got this great idea. They're ready to launch their company. They take their own savings and they put it right into the business's bank account.
Right to the company, yeah.
That capital can be used for anything, really. I mean, it could be those initial costs of setting things up, like, registering the business, getting a website, all of that. It can also help with cash flow in those first few months when, things are slow before the sales really start rolling in. And it can even help finance, maybe a small expansion as the business starts to find its feet.
Yeah, and there are some pretty big advantages to going this route, right? First off, no interest payments. I mean, that's got to be a huge relief, especially when you're just getting started and every penny counts. Plus, the owner keeps total control, which I imagine is super important for many founders.
Yeah, absolutely. No outside lenders or investors poking around trying to influence decisions. And usually this is a pretty quick process. There's no need to go through a long application process or wait for, some bank to give you the thumbs up. And maybe most importantly, especially early on, when an owner puts their own money in, it shows they really believe in this. They're committed. And that can be really reassuring for potential investors down the line if they need to seek out more funding later on.
It sends a strong signal, yeah, absolutely. But even with all those positives, there are, of course, some downsides too, right? I mean, for one, someone's personal savings are, well, they're limited. There's only so much they can put in, and that could hold the business back from growing as fast as it could.
That's a big one, yeah.
Yeah.
You're absolutely right. There's a finite amount you can invest from your own pocket. And then there's the very real risk, the personal financial risk. If the business doesn't succeed, well, the owner could lose a big chunk, maybe even all of their savings.
Yeah.
And that's a tough pill to swallow.
Oh, absolutely. It's a huge risk.
And then you also have to think about the opportunity cost, right? I mean, that money could have been used for something else, another investment maybe that could have had a good return.
Yeah, that's a really good point. So a classic example of this would be, let's say someone's starting a small online business, like they're making, I don't know, handcrafted jewelry or something. They're probably going to use their savings to buy those first materials, to build their website, that sort of thing.
Yeah, a perfect example. Makes total sense as a first step.
Okay, so that's personal savings. What about retained profit? That's another internal source our research talked about.
Right, retained profit. Think of it like this. It's the earnings that the business has made, over time that haven't been paid out to the owners or shareholders as, profit distributions. Instead, they're kept within the company, like tucked away in a savings account, ready to be reinvested.
Okay, so it's like the business is building its own little nest egg from its past success.
Exactly.
And our sources explained that this is done by taking a chunk of the net profit that's after all the expenses are paid, taxes, and any dividends that go to shareholders, and putting it into a special account, a retained earnings account.
Right. And then that pool of money can be used for all sorts of things. Imagine a tech company using its profits to develop a new software feature, or a restaurant that wants to, renovate their space. It could be expanding into new markets, buying new equipment, even paying down debt. It gives the business a lot of flexibility.
Yeah, and the upsides are pretty compelling. No interest to pay, which is always nice. And like you said, there's a lot of flexibility in how that money gets used.
Yeah,
And I like that it doesn't dilute ownership. You're not bringing in new shareholders or...
exactly. And having a good amount of retained profit makes the business look more stable financially, which can make it more attractive to lenders and investors down the road.
It makes them look good, yeah.
Oh, yeah.
But are there downsides to relying on retained profit? I mean, especially for a new business, they may not have much profit to even retain, right?
That's the big one. It's totally tied to how well the business has done in the past. If they haven't had much profit, there's not much to retain. And sometimes, the owners or shareholders might prefer to receive those profits as dividends, get paid out instead of seeing it all go back into the company. And then, just like with personal savings, there's that opportunity cost to think about, could that profit have earned more if it was invested somewhere else?
Yeah, always those trade-offs to consider. So it's about finding that balance, keeping enough to reinvest while also making sure the owners are happy. Okay, so we've talked about personal savings, retained profit. The last internal source of our material covered is the sale of assets.
Right, the sale of assets. This is basically where a business makes money by selling things that it owns but doesn't really need anymore. We're talking about things like, I don't know, maybe some old machinery that's not being used, extra vehicles, or maybe even some land that's just sitting there, or too much inventory.
It's like cleaning house, getting rid of the clutter to free up some cash. And the process seems pretty simple, at least on the surface. Figure out what you don't need, find someone who wants to buy it. Our sources did mention this interesting thing called a sale and leaseback, where a business sells something, often their property, but then immediately rents it back from the buyer so they can keep using it.
Yeah, that's a clever way to do it. It's like unlocking a bunch of capital that was tied up in the property, but you still get to keep using it.
Right. Smart move. So, when might a business decide to sell assets?
Well, lots of reasons. Maybe they just don't need that particular asset anymore. It's not essential to what they do. Or maybe they need a quick influx of cash, and selling an asset is the fastest way to get it. Or, like we said with sale and leaseback, it could be a way to free up capital so they can invest it in something else. And sometimes selling off slow-moving inventory can really improve cash flow and, reduce those pesky storage costs.
Makes sense. And what about the advantages? It sounds like you could potentially get a lot of money, especially if you're selling something variable. And again, no interest payments to worry about. Plus, the money you make can be used for whatever you need right away.
All true. But of course, there are potential downsides too. What happens if you sell something and then, down the line you realize you actually needed it? That could really mess things up. And finding a buyer can be tough sometimes. It can take a while, and you might not get the price you were hoping for.
Yeah, especially for specialized stuff.
Exactly. And then there are the costs of selling, things like commissions or fees. And if you make a profit, you might even have to pay capital gains taxes.
Okay, so it's not always as simple as it seems. You got to think things through carefully. So we've talked about the ways businesses can find funding from inside the company. Now let's switch gears and talk about external sources getting money from outside the business.
Sounds good. Now we're talking about going beyond the company's own resources and looking to outside sources for capital. And our sources did a good job of breaking these external options down into two categories: short-term and long-term.
Right, short term being for when you need money for less than a year. Usually I handle things like, immediate expenses and managing cash flow. And long term is for when you need it for more than a year, typically for bigger things like investments or expansion.
Exactly. Short-term is like a quick fix. Long-term is more strategic.
And the materials you sent listed a ton of different external funding options: bank loans, overdraft shares, even government grants. It's a lot to take in. So how does a business decide which one is right for them? What are the key things they need to think about?
That's the million-dollar question, isn't it? Picking the right type of financing is super important for a business to stay healthy in the long run. Making the wrong choice can really come back to bite you.
Okay, so let's break down these key factors one by one. The first one, and it seems like common sense, is what are you actually using the money for? I mean, you wouldn't take out a short-term loan to build a new factory, would you?
Exactly. If you're trying to get long-term assets, things like new equipment or property, you're going to need a long-term financing option, like a loan with a long repayment period or a commercial mortgage. But if you're just trying to cover some short-term costs or smooth out your cash flow, then a short-term solution like an overdraft or trade credit is probably better.
Okay, that makes sense. What about the amount of money needed? I mean, a new business might only need a few $1,000s to get going, while a big expansion project could need millions.
Right. If you need a large amount of capital, you might need to look at things like selling shares, which means giving up some ownership in the company or getting a big long-term loan from a financial institution. But if you just need a smaller amount, you might be able to manage with personal savings, a business credit card, or a smaller overdraft.
Okay, so the amount definitely dictates the options. Then there's the length of time you need the financing for. That's kind of tied to the short-term versus long-term thing we just talked about. But you also have to think about, when and how you're going to pay the money back.
Absolutely. If you're dealing with a temporary cash shortage, you might look at trade credit, where you have a longer time to pay your suppliers, or an overdraft that you can pay off quickly. But if you need the money for a longer period, you might need to get a loan with a repayment schedule that stretches out over several years, or maybe even consider equity financing, which is more permanent.
Right. And of course, you can't forget about the cost of borrowing. Those interest rates and fees can really add up, and they can impact how profitable your business is.
Definitely. You have to carefully compare the total cost of different financing options. Don't just focus on the interest rate. Look at all the fees and charges involved. Remember, cheap can mean different things. It can mean no interest at all, like with those internal sources, or it could just mean a lower interest rate compared to other options.
So shop around and read the fine print, basically. Another big thing to think about is risk. Taking on too much debt can put your business in a risky position, especially if the economy takes a downturn or if something unexpected happens.
Oh yeah. Debt can be a real burden if your cash flow becomes unpredictable. Now, equity financing, where you sell a part of your company, avoids that whole debt repayment thing. But the trade-off is that you're giving up some control over your business.
Which leads us to the next factor. How much control do the owners want to keep? Some business owners are really adamant about making all the decisions themselves. They're much more likely to choose debt financing over giving up some ownership through equity.
Right. With a loan, once you pay it back, you're done. But with equity financing, you're bringing in new people who have a say in how the business is run. It's a trade-off.
Okay, so we've talked about the purpose, the amount, the time, the cost, the risk, the control.
Yeah.
What else? Oh, right, the type and size of the business also matter, right? A tiny mom and pop shop is going to have different options than a huge corporation.
Oh, for sure. A small business might start with personal savings or loans from friends and family. But a big, well-established company has more options. They can issue shares on the stock market, or they can offer corporate bonds, which are like long-term loans with a fixed interest rate.
So bigger companies have more tools in their toolbox. And then the last thing to consider is the current financial situation of the business, right? If they're already carrying a lot of debt or struggling to make a profit, that's going to affect what lenders are willing to offer and what kind of terms they'll give.
Exactly. Lenders and investors want to see a strong track record. It makes the business less risky. A healthy financial history can lead to better terms and more options.
So it's not just about finding any old source of money. It's about being strategic and choosing the right one for your specific situation. And I really like how the materials you sent included this table that summarized the key differences between short-term and long-term financing.
Oh yeah, that table was super helpful. It laid out all the basics really clearly. Short-term financing is for less than a year, usually for operational needs, and it's generally considered less risky by lenders. Long-term financing is for more than a year, usually for buying assets or expanding, and it's seen as riskier. The table also gave some specific examples for each type, which was really useful.
Examples are always good. So we've gone through all these different factors, but I think it's worth emphasizing why making the right choice is so important. We've touched on some of the individual downsides, but what are the bigger consequences of getting this wrong?
Well, like we talked about, if your loan repayments are too high or the interest rates are killing you, you can end up with serious cash flow problems. That means you might not be able to cover your basic operating expenses. High interest rates and fees can also eat into your profits, which is never good. And if you choose equity financing without really thinking it through, you might end up giving away too much control of your business. And in the worst-case scenario, bad financing decisions can lead to a business going bankrupt.
Yeah, that's the last thing anyone wants. On the flip side, choosing the right financing options can give you more stability, fuel your growth, and help you weather any storms that come your way.
Exactly. It's not just about getting the money. It's about making sure the financing fits your business goals, supports your long-term plans, and doesn't put you in a financial hole.
Right. And our sources provided some great real-world examples of how different businesses use different types of financing. I always find it helpful to see how these things play out in practice.
Me too, yeah. Like, imagine a new bakery just starting out. They might use their personal savings, maybe a small loan from family, to buy their ovens and ingredients. But a growing online retailer that wants to expand their product line and marketing, they might be able to get a bank loan, especially if they have a good sales history. Or if they need a lot of money to grow quickly, they might sell shares to investors.
And what about those situations where a business needs money quickly, like for a short-term need?
Well, a small shop that needs to restock their shelves might use an overdraft or work out a deal with their suppliers to pay them later. A manufacturing company that wants to buy new, more efficient machinery might use a hire purchase agreement where they pay for it over time. Or they could get a specific loan for equipment. And then there's the tech startup with huge potential but not a lot of cash. They might seek out venture capital, where they give up some ownership in exchange for investment and expertise. And a big corporation that wants to build a new factory, they might issue corporate bonds to raise money without diluting their shares, or they might get a commercial mortgage on the new property.
It's amazing how many different ways there are to finance a business. And the FAQ section in the materials was really useful. It covered some of the most common questions people have about business financing.
Yeah, those FAQs are great for getting the basics down.
Yeah.
Like, what's the difference between short-term and long-term financing? We talked about that. But the FAQs lay it out simply.
Right. And they also answer that big question everyone has: what's the best way to finance a new business?
And as usual, the answer is it depends. But often it starts with personal savings, maybe some help from friends and family, and potentially looking into things like venture capital or trade credit.
And the FAQs also go back to that fundamental question: why do businesses even need financing in the first place?
Right. And the answer is there are tons of reasons. Startup costs, growth, buying inventory, paying expenses, research and development, new equipment, managing cash flow. It's a long list.
And the FAQs also talked about the big decision between borrowing money and selling shares, debt financing versus equity financing. It's all about finding that balance between keeping control and having to repay what you borrowed. And they touched on what happens if you can't repay your debts, which is not a good situation to be in.
Definitely not. That can lead to penalties, a bad credit rating, even losing assets or going bankrupt. That's why it's so important to make smart decisions, understand what you're signing up for, and be realistic about the commitments you're making.
So, to sew up, it's really clear that understanding the different ways to finance a business, both internal and external, is crucial for success.
Couldn't agree more. It's all about knowing what your options are and picking the right ones for your business.
And all those factors we talked about: the purpose of the financing, the amount, the time, the cost, the risk, the control, the type and size of the business, and its financial health. Those are the things you have to weigh carefully to make the right decision.
Absolutely. And the good news is that there's so many options out there. Businesses have a lot of flexibility to find the right financing for their specific needs and goals.
It's all about finding that perfect fit. So, to wrap things up, it seems like a good understanding of business finance can be a real game changer. It can help entrepreneurs and business leaders not only stay afloat, but actually thrive and achieve their dreams.
I couldn't have said it better myself.
Well, this has been a fantastic deep dive into business finance. Thank you so much for sharing your expertise and helping us make sense of all this information.
It's been a pleasure. It's such an important topic, and I'm glad we can shed some light on it.
And to you, our listener, as we wrap up this exploration of business financing, here's something to think about. What do you think is the most underutilized source of funding for businesses today? And why might businesses be overlooking it? Think beyond the usual suspects. There might be a hidden gem out there just waiting to be discovered. Thanks for joining us for this deep dive. It's been a great conversation, and I hope it sparked some new ideas and insights for you.